Next is an examination of Bed Bath & Beyond stock chart. Gap up and gap fill zones form the frame of the later double bottom range that has a slight incline for additional bullish strength. Another reminder here, showing gap up and gap down fill zones can be widened to accommodate swing points around the gap fill range, with most influence centering around the candle before the gap formed. To be even more precise, most attention is normally concentrated around the real body range of the candle before the gap formed. This applies to gap up and gap down zones that often have most activity focused within the range of the initial candle that formed the gap up or gap down. Supporting influence starts from the wider gap fill region just above 68 due to the upper wick of the candle on March 27th, forming a recent swing point prior to the recent gap up. Later, when the gap is filled right to the range of the candle on April 4th, most attention in the gap fill zone is around the real body range of the April 4th candle. In this example, most resistance begins to concentrate around 72 from the closing to the high price of the April 5th candle. This is perfectly natural since once again it is normal for most market attention to be drawn to the price ranges of candles that form gaps. Market attention waits to see if trading can stay over 73 after the current candle traded under the preceding bearish star's low. It is an unsuccessful climb and a quick drop back towards the 70 boundary, where the main focus is around the opening price of the gap up candle. A relatively parallel channel emerges to surge back up right around the lower boundary of the gap up zone that begins from the opening price of the gap up candle. A closer look from a short-term perspective from the past few weeks also reveals bullish moves were generally stronger with higher volume in comparison to bearish activity. Bearish sentiment returns strongly in the short term with the bearish engulfing, and in the medium to long term the upper resistance range is not successfully cleared yet, especially with the upper trend line from the channel still resisting. This is a good example where longer-term bearish context dwarfs relatively short-term bullish developments. Selling is quickly exhausted from the large drop and range from the gap down zone. That can easily be defined by the opening and closing prices of the large red gap down candle. Eventually, trading inclines and attention is directed at seeing whether the market will continue with a successful break over 65.20 and extended resistance offered from the gap fill zone stemming from early April. It was a case of overselling on a grand scale. Price reverses quite passively without major bullish spikes, since the bearish advantage had been expended by early July, following the largest red spike in recent years. The old resistance immediately prevents contact with the gap down fill zone, that is, defined by price levels 75 and 73, around the high, open, and low prices of the candle just before the gap down. Despite high bullish volume on this current day, it is important to remember the candle is a doji for a more neutral to bullish stance in the very short term, while the context is still quite bearish in the medium to long term, near prior major resistance and the more recent gap down fill zone just out of reach. In addition, the previous candle strongly closed under the preceding bearish harami. It is less of a surprise when another strong gap forms due to the bearish background, instead of one major red candle to exhaust selling, following the gap down. This allows for more constant selling pressure to easily remain and form another gap down. minor resistance and support from the gap down and gap fill ranges into 2013. Long-term resistance in the upper 70s is still a consideration. Another example of a gap up fill zone providing excellent support and reusing the 75 level. That lines up nicely with the upper boundary of the gap fill zone. Still paying close attention to the sustained long-term resistance. It is a slight break higher, but bearish sentiment doesn't diminish, as seen by the rapid return of large red candles and volume. Slightly more progress this time to contact the 80 boundary, but there was no bullish momentum in the short-term context to build on the preceding gradual incline. A clear sign of lower confidence in the market. Some major support is found at 63, largely from prior long-term resistance, from late 2011 to early 2012, and the first gap down range with the minor incline from around July 2012. Market attention also accumulated from other clear gaps and swing points in the low 60s. However, the market remained overly bearish to drive back into the 50s. At which point it was another case of tremendous overselling, following another gap down towards July 2014. It turns out support in the mid-50s runs near the upper boundaries of two double bottom ranges, and is actually the high price of a gap up candle from years past. In the short term, it can be considered a reversal of a small double top at the gap up area. It does resemble a double bottom range, but overall this is sideways price action in a larger uptrend, and it is more suitable to say this is part of a resting phase range centering around 63 to form a bullish continuation. Back up to 80, but another downtrend develops. It is certainly an interesting case where a gap down is filled and transitions into a likely descending triangle to accelerate the drop if 73 is cleared soon. A relatively weak break completes the descending triangle. A rapid upswing originating from the perfect bull hammer on May 14th finds natural opposition from 73, now reversing roles to present resistance. It was definitely a weak break of the descending triangle, but its base provided strong resistance to the bullish surge to produce an accelerated downtrend. Large-scale 3 methods falling price action from August to November put a quick end to the early uptrend with help from the steeper descending trend line, back above the upper boundary of the major support range, originating from the gap fill in 2011. After December 22nd, the downtrend weakened drastically, since it was unsustainable for price to keep falling after the bullish to neutral price action kept contact with the 49.50 level. Even a minor spike in selling to begin 2016 was not enough. If anything, that contributed to even more overselling. In the next few weeks, there was a flat range that can be considered a triple bottom. Influence from the descending trend line is increased due to the markets struggling to keep closing over 49.50. Just like how an uptrend needs regular dips to relieve selling pressure, a downtrend needs periodic upswings to be more sustainable. Support from the last triple bottom helps in finally overcoming the downtrend line to begin a minor neutral to bullish stance. Bullish advantage is not maintained and the long-term drop resumes. This turns out to be an extraordinary case of a large head and shoulders made up of multiple bearish and bullish patterns. Trend lines from the right side were also helpful in gauging the strength of minor upswings before, during, and after the break of the neckline range defined by the 49.50 to 55 range. As seen before, it can be easier to identify large-scale patterns like this with the use of a longer time frame, such as a weekly or monthly chart.